The current environment in the Bitcoin market is one of subtle but profound deception. For weeks, the price action has offered the illusion of clarity, tempting participants with sharp moves that ultimately reverse course. This is not a market of simple direction, but a carefully constructed maze designed to maximize confusion and extract capital from those who commit too early. The recent volatility has served as a powerful reminder that the market's primary function is often to trap the unwary, whether they're betting on a rapid ascent or a swift decline. This content is provided for informational purposes only and should not be considered financial advice. Market conditions can change over time. The overall mood surrounding Bitcoin has shifted from the optimism that characterized the start of the year to a state of deep caution. The market recently experienced a significant retreat, surrendering the psychological ground that had been established over the preceding weeks. This sharp move effectively wiped out the gains accumulated since the beginning of the year, leaving many participants questioning the underlying strength of the asset. The prevailing context is defined by a narrow, contested range where every attempt to establish a clear trend is met with an equally powerful counterforce. This back and forth action creates a sense of fatigue and indecision, which is precisely the environment where the most sophisticated market players thrive. The market is currently operating in a zone of maximum pain, where the cost of being wrong is amplified by the speed of the reversals. The most notable recent activity has been the dramatic clearing of over-leveraged positions. In a short period, the market witnessed a massive wave of forced selling, a scenario where falling prices triggered automatic closure of long bets, which in turn accelerated the downward movement. This cascade of liquidations amounted to a substantial figure, indicating that a large number of traders were positioned for a continued, uninterrupted rise. Their collective capitulation provided the fuel for the sharp drop. Crucially, this was not merely a technical flush of speculative capital. Data shows that this decline was supported by aggressive selling in the actual spot market, suggesting that motivated sellers were actively seeking to exit their positions, overwhelming the available buying interest. Furthermore, the behavior of high net worth investors, often referred to as whales, has contributed to the defensive posture. Significant amounts of Bitcoin were observed moving onto exchanges, a historical precursor to increased selling pressure. When interpreting this current behavior, it is essential to look back at the history of volatile markets. Periods of intense consolidation, often following a major price run, are rarely smooth. Instead, they are characterized by these very traps, false breakouts, and sudden deep corrections. This pattern is a classic sign of a market transitioning from a phase of high momentum to one of structural re-evaluation. The market is effectively testing the conviction of every participant. The sharp movements that briefly push the price above or below key levels are designed to lure in both the aggressive buyers and the aggressive sellers. When these moves fail to hold, the trapped participants are forced to reverse their positions, providing the necessary liquidity for the larger players to accumulate or distribute their holdings. This process is a necessary mechanism for clearing the market of weak hands and establishing a more solid foundation for the next sustained move. The current directional bias is one of extreme neutrality, punctuated by violent swings. The price is currently oscillating around a critical psychological level, which serves as a dividing line between a healthy consolidation and a deeper correction. This level represents the average cost for the most recent entrants to the market. As long as the price remains above this defense line, the short-term holders maintain a sense of equilibrium. However, a sustained move below this point would immediately place these cohorts into a state of unrealized loss, making them highly susceptible to panic selling and accelerating any potential downtrend. Conversely, the path upward is not clear. Just above the current trading range, there are significant clusters of supply, representing the break-even points for traders who bought in during the previous rally. These traders are likely to sell into any relief bounce, creating a natural ceiling that must be overcome with substantial buying volume. The market is therefore caught in a tight, high-stakes tug of war, with neither the buyers nor the sellers able to claim a decisive, lasting victory. The sentiment among market participants has become noticeably defensive. This is reflected not only in the aggressive selling seen in the spot market, but also in the derivatives space. There has been a clear shift in the options market, with a growing preference for instruments that provide protection against a fall in price, rather than those betting on a continued rise. This defensive positioning suggests that institutions and sophisticated traders are hedging their exposure, anticipating further volatility or downside risk in the near term. The short-term holder cohorts, those who entered the market most recently, are particularly fragile. Having seen their early year gains evaporate, they are now operating with a low tolerance for further losses. This collective nervousness means that any minor negative news or price dip could trigger a disproportionate reaction, leading to further selling pressure. The community is watching the critical defense level with intense scrutiny. The short-term outlook suggests a continuation of this highly volatile, range-bound behavior. The market is likely to remain choppy as it attempts to resolve the current structural imbalances. On the upside, the immediate challenge is to absorb the significant supply that sits just above the current price. This selling pressure, originating from traders looking to exit at their cost basis, will act as a formidable barrier. On the downside, the market must hold the critical defense line to prevent a cascade of panic selling from the newest participants. A failure to hold this level would open the door to a deeper search for support. Therefore, the immediate future is less about a clear direction and more about a process of price discovery within a confined but violently contested space. Patience and a focus on capital preservation are likely to be the most rewarded strategies in this environment. While the short term is dominated by internal market mechanics and traps, the longer term perspective remains anchored to the evolving global financial landscape. The current volatility is occurring against a backdrop of significant macroeconomic uncertainty. The tightening of global liquidity, triggered by events in traditional sovereign bond markets, is a powerful headwind for all risk assets, including Bitcoin. However, this very instability also reinforces the long-term narrative for digital assets. As traditional safe haven assets show signs of fragility and central bank policies become increasingly politicized, the case for a non-sovereign, decentralized asset like Bitcoin gains structural weight. The current market chaos, while painful, can be viewed as a necessary stress test that ultimately strengthens the asset's long-term position as a strategic component in portfolio allocation. The structural forces at play suggest that the current price action is a temporary, albeit intense, distraction from the broader, multi-year trend of digital asset adoption. The risks in the current environment are twofold: internal and external. The internal risk is the continuation of the liquidation traps. The market has demonstrated its capacity to aggressively clear out both bullish and bearish bets, meaning that committing to a directional trade with high leverage remains extremely hazardous. The external risks are centered on global financial contagion and geopolitical tensions. The phenomenon of tightening global liquidity, stemming from instability in foreign bond markets, is a powerful external force that can override internal market strength. Furthermore, the threat of renewed trade tariffs and geopolitical friction adds a layer of macro uncertainty that encourages institutional investors to adopt a defensive, risk-off posture. This convergence of internal market traps and external macro headwinds creates a highly uncertain environment where sudden, sharp movements can occur without warning, driven by factors entirely outside the crypto ecosystem. In conclusion, the Bitcoin market is currently engaged in a sophisticated game of trapping both the aggressive buyers and the eager sellers. This is a time when discipline and awareness are far more valuable than conviction. The focus should be on observing how the market reacts to the critical defense and supply levels, rather than attempting to predict the next major move. The market is clearing out the noise, and the most prudent approach is to remain patient. Avoid the temptation of high leverage and recognize that the current volatility is a function of a market seeking structural balance. The long-term narrative for Bitcoin remains intact, but navigating the short term requires a calm, detached perspective.